Well, that's what I wanted to talk about at first, about that underlying PCE data. Taking out food, taking out energy, which are, after all, the most volatile items, the pressure continues to increase. In the last month, it has increased by 0.4%. And if we look at the year-on-year data here, the increase is even higher, almost 3 points.
Yes, that is correct. In other words, it is in line with expectations, but it shows that obviously it is accelerating with respect to the previous period, which was 0.1%, and instead now it is at 0.1%. So it does not rule out the internal fears that the Federal Reserve has, which is that this inflation rate may in fact be fears that the Federal Reserve has, which is that this inflation rate may in fact be activated. One of the thoughts that we shared a few days ago and that we also mentioned was precisely that of the main concerns that the Federal Reserve may have is that the composition of that EPC, that it is basically around services. Services are based on the labor market. So what we are seeing here is that what the Federal Reserve is afraid of is that with such a strong labor market and knowing that the composition of inflation, where the core is basically based on services, on service prices, the only way it can guarantee that this inflation does not continue to thrive or that it is held back is that the company, the service sector, does not raise prices, and to do that, you have to push up unemployment. In other words, the US labor market must be made to cool down, to become more flexible in order to ensure that there is no upward pressure on the inflation rate through wages. It's as simple as that. And I think that's really what the Federal Reserve is concerned about, as has also happened to Japan and so on. Why not? Because to date, we have heard statements from different Federal Reserve officials who precisely have said, as I have mentioned on some occasions as a joke, where I said, patatao, I say potato. Here, the one who put on the table the rate record was Jerome Powell, and that they had considered in the year 2024 to make several rate cuts and so on. And after Jerome Powell, there have been different presidents of the different Federal Reserves, of the different federal banks, who have mentioned that they had considered cutting rates and so on. Why the urgency to cut the rates now? We cut the US growth rate, as the colleague was saying now, downward, but 0.1% downward. In other words, we went from growing at 3.3 to 3.2. China is facing a very serious economic slowdown and a very weak real estate sector. Europe is in an economic recession. It has a negative growth rate. Is it the US that needs to cut rates, or is it not an urgency for the US to cut rates? And, well, because of a multitude of issues that we have said, the labor market is extremely strong with an unemployment rate below 4%. We are at 3.7, 3.8, if I'm not mistaken. And key here would be, Javier, above all, which we will certainly discuss next week, that the audience has it noted there. Friday is the non-farm payrolls. That is when we will see employment data from the US labor sector, which will undoubtedly add fuel to the Fed's decision, for better or worse. Because then we will see that there is more data to count on as to what might happen. But the market discounts, the rate cut that since December, the whole bull market, what they were assuming was a March rate cut, which is not happening, which is being postponed, and with any such data, which is scary in terms of inflation rate, is going to make them push it out there until the end of the year. Even 2 rate cuts instead of 4 that they promised. Hopefully they don't keep getting suspended.
Precisely because of the labor market, as you were saying, next Friday we have the non-farm payrolls data, and we have just had the unemployment benefit renewals data at midnight, which also shows that the US market is gradually relaxing and cooling down. The 215,000 renewals have been signed above estimates, so little by little, it is true that these are weekly data, therefore much more volatile than a data like the one for next Friday, but it does give us a gradual picture that the labor market is cooling down, and it is doing so in a way that at least more accelerated than expected.
What does Wall Street need? Wall Street needs bad data. It needs bad macroeconomic data to justify a rate cut. If good data continues to come out, if the labor market responds positively, if the growth rate is strong, if the inflation rate continues to cool, there is no reason to cut interest rates. Well, sorry, if the inflation rate continues to pick up, there is no reason to cut interest rates, and therefore they don't have, on the one hand, the need, and on the other hand, the caution to keep rates as they have them today. And we are seeing the bond market doing the same thing. It reacts, yields go up, then they go down again, and we are like this every other day. So it's not at all clear what the Fed is going to do a month from now.
I don't know if the problem is that the data is bad, but not so bad as to say that we are in a moment of clear deceleration because there are barely 5,000 more renewals than the market expected.
Yes, that is correct. Yes, but I insist, if there is a rebound, for example, in unemployment above 4%, I tell you that the response that Wall Street is going to have is going to be bullish. In the one of the year, something very similar happened to us. In the one of the year, there was monetary stimulus, there was QE, quantitative easing, until the US unemployment rate went below 6%. What happened? Any rise in the unemployment rate in the United States was celebrated by Wall Street. The markets went up as if there was no tomorrow, basically because they assumed that there was going to be a perpetual bailout of financial assets by the federal government. That's sucking in money. As long as the data is bad, there is going to be monetary stimulus to spare. And as Alan Grisman said, if there's no problem, well, even Cascaris, the liquidity of the Federal Reserve is unlimited because you can always print more money.
And then the personal spending data, which I was just looking at now as well, is still up in January by 0.2%. So that, as we were commenting yesterday at the close of Wall Street, the situation of consumption, and despite the fact that companies are stopping investing or at least slowing down their investments because of what might happen, the problem is that ordinary citizens do not trust that things are going to go badly.
Exactly, and that's positive. I mean, it's still playing the same thing, retail sales, personal consumption. As long as all this data pulls, it continues to feed back into the US microeconomy. And so you can't have bad or negative data if the consumer is still going to spend the money and businesses are still operating. That's why I say that any positive data, let's say, that takes away the possibility of an extremely bullish market for monetary stimulus, and any negative data feeds Wall Street. Therefore, the contradiction that we see in this case, and this is not new, I insist, this happened years ago when QE was withdrawn or there was speculation that it would be withdrawn. Exactly the same thing happened. Bad data re-emphasized the expansionary policy of the Federal Reserve or the accommodative policy of the Federal Reserve. Positive or strong data take away the legitimacy of monetary stimulus, which is what Wall Street wants, which is to get drugs into the market.
Well, this is what we have to stay with because we are running out of time. Gonzalo Cañete, as always, a pleasure, and see you tomorrow.
To you, a pleasure.